Hello, I'm Beaulieu from ITR Economics. Welcome to the February 9th, 2024 edition of FedWatch. Some interesting things going on at the moment. I was recently reading Fed Governor Kugler's speech that she was giving at the Brookings Institute. And, she's one of the newer members. She came on in September 2023. And the reason I liked her was she tended to be really focused on labor. She's tempering that within the Fed, but she's got a keen eye on what's going on in labor. And she was making the following points. They're really pleased with the decreases in the rate of inflation that they're seeing, particularly if you look at what's been going on over the last 6 months in some of the subcategories. They know that the housing and the rental aspect of it is an ongoing issue. But when they look at other aspects, particularly goods, they're pleased with what they're seeing. The other point she was making is that they're seeing real movement in the wage inflation. It's stickiest in the service sector, obviously, and the service sector is doing quite well, so you'd expect that it's going to be sticky there. But they're confident that they're going to make some more strides in that area. And she went on to say that she sees that their personal consumption price index, this is the personal consumption expenditure, so PCE price index, it's going to come down to that 2.0% range in 2024. And this was an interesting little shift. She goes, they'll be happy with that. They expect that PCE core inflation will be a little bit higher than that, maybe as high as 2.9. But if the overall PCE price index is 2.0, she's going to call that a win. And that's really encouraging because that means they're getting off their only focused on core inflation, and they're willing to look at the broader picture, which is great. The Fed is expecting employment to remain relatively strong through this period, and that's good news for the home team also in terms of what it means for this business cycle. Hope they're right. And all of that is counterbalanced, however, with the strong January jobs report. Now, it wasn't out of the ballpark crazy, but it was better than we thought it was going to be, let alone the consensus of other economists. That the rate of change didn't really move. January tends to be a strong month, but it was still the December to January movement, like last year, was particularly strong. So, as was true of money supply, we're going to know a lot more with the March-April data, which is now right around the corner, interestingly enough. You're going to see through your ITR trends report or future blogs, trends talks, that at ITR we are taking the first quarter decline in GDP out of the forecast. We still have a quarter of decline, but instead of 2 quarters of decline, non-consecutive in 2024, we're going down to just the third quarter being a negative quarter on a Q-to-Q basis. The slowdown is apparent to us in the leading indicators, and I explain that in the trends report. You can read all about it there. Net, what it means is we think we're still on track for the second quarter onset of decline in interest rates. We don't expect it's going to be significant, particularly in light of the slightly stronger GDP trend for 2024. Instead of flat with a tendency for down, it's now flat with a tendency for rise. That could all add up to we're not going to get much of the way of an interest rate decline that, say, TD Bank was talking about, as I mentioned several months ago. We still expect decline. We still expect that by the end of 2024, early 2025, interest rates are going to be in their sweet spot for this business cycle. And we are already seeing the leading indicator signs of the rising trend that we expect will start in 2025. So it's not going to be a bad year ahead. It's going to be a year where you're going to want to make market share gains. It's going to be a year where you're going to figure out your leveraging, your cash flow is going to be tight. If you haven't already done your cash flow analysis, you still have time to do that because credit conditions are still tight. But this is not going to be a bad year before we get into the next lift, the next business cycle rise there in 2025. So not much has changed is what it comes down to. But it's nice when the numbers are lining up to fit what we thought was going to be happening, except for that January jobs report, which just, from my mind, just solidified they're not doing anything with interest rates in the first quarter. they are clearly going to wait till the second quarter at the earliest. Thanks for watching us for this edition of FedWatch. As always, it's been a pleasure.